So our first speaker is Bryce Gill, First Trust Economics team. Bryce is responsible for analyzing economic indicators, producing economic commentary, and presenting timely insights on the economy and financial markets. Today, he'll provide his analysis on how the trade policy, geopolitical shifts, and the Federal Reserve are influencing today's market and the economy. Bryce also travels nationally as one of First Trust speakers, sharing perspectives with professionals and everyday investors. Bryce has been recognized for his thought leadership, and Bloomberg has ranked First Trust as one of the top forecasters of the U.S. economy in recent years. Bryce is based in First Trust Austin, Texas office. He holds an MBA from the University of Texas McCombs School of Business and a BA in economics from the Miami University of Ohio. So please join me in welcoming Bryce Gill. Thank you.
Absolutely. All right. Well, good evening, everybody. Early evening, afternoon. Can everybody hear me okay?
Yes.
Thank you guys so much for coming out. Thank you to Return on Life Wealth Partners for having us. And man, it's like an honor to be the guy kicking this whole thing off and among like such a esteemed group of sponsors, right? So I'm happy to be here. It's always nice coming back to the Midwest during summertime. So I'm originally from the Chicagoland area. I did college in Ohio at Miami University. And like the Midwest summers just cannot be beat, honestly. I'm down in Texas now, and it's been like 3 or 4 months straight, guys, of 100 degrees every single day, right? So it's a blessing to get to do this and get to ride a shuttle in and see giraffes on the way. And I do probably at least like 100 live presentations like this year, maybe more. And I think it's the first time I've ever spoken at a zoo, so this is pretty fun. I've got the ostrich boots on to commemorate the occasion. But guys, there's so much to talk about today, right? And I've only got like 25, 30 minutes of time to be with you and cover, you can't cover everything in the economy, right? So I'm gonna try and hit the big picture stuff that I think matters the most, okay? And recently, most of the focus has been on the Federal Reserve because they started cutting interest rates, right? And we're all kind of happy about that. It's nice to see maybe interest rates go down a little bit. But, you know, guys, my personal opinion is I think the Federal Reserve is just not that important right now, okay? They're gonna cut a couple of times, but at the end of the day, the Federal Reserve has very limited control over the interest rates that really matter for the economy, and especially for like everybody in this room, for the interest rate that goes into the valuation of your stocks and your bonds and everything else. Typically that's like longer term interest rates. So think of like the 10-year treasury yield, right? The Fed can only control really short term interest rates. Longer out on the treasury curve, like a 10-year treasury yield, that's really driven by the market, okay, in a lot of ways. So think, what's happening with inflation, what's happening with the government budget, right? A whole host of things can affect those longer term rates. And so, what I really want to focus on today, guys, is what's been happening with trade policy in the United States, because frankly, I think it's some of the most interesting stuff going on in the world. And so we'll go into detail about some of the tariff stuff, guys, what to expect like economically from tariffs. But, I really want to do more than just kind of hit you with like tariff numbers, okay? I think the reality is like, there's a lot of benefits to modern society and like having access to all this information at our fingertips, right? But the downside to it is that every single day we're drinking from a fire hose of information, right? And I think when that's the case, sometimes it's hard to see the forest through the trees, see like the big picture of what's been going on. And that's what I also want to do here today. Let's give you a little bit of context. Maybe it'll leave you with a couple thoughts you haven't heard before. And then at the end, we're going to have time for Q&A, as I mentioned, right? So try and leave like 10, 15 minutes for Q&A. Feel free to ask anything that's top of mind, guys. Seriously, I can't guarantee I'll have an answer for you, right? But nothing's off the table. I'm happy to do my best to answer whatever's most important to you, right? That's what we're here for. So thank you again for coming out, and let's get into some of this information. And as I mentioned, guys, I want to kind of start big picture on trade, okay? Because we have seen some really huge shifts with trade that I think have a huge impact on the status quo around inflation in the United States, okay? So most people know like the Federal Reserve, they have a 2% inflation target, okay? Okay, 2% is considered normal in the financial markets. It's what the Fed's sort of goal is. Okay, if we hit 2% inflation, they basically declare victory or say, hey, we're back to normal again, right? And they've started cutting anyway, even though inflation's still higher than they want it to be. And I'll get into some of the reasons why that is. But the picture is like 2% has been normal for a really long time. Okay, and if you open an economics textbook and you read about inflation, I'll give you a really simple kind of summary of what you're going to read, okay, which is that in the early 1980s, we had double-digit inflation, and so Paul Volcker was the Federal Reserve Chair. He comes in office and he hikes interest rates to like 20%, okay, and that beats inflation into submission. And ever since, we've had like this steady hand on the wheel of monetary policy, and it's kept inflation at 2%. And we've had this like really even inflation rate since then. Okay? And I always thought that left out a massive part of the story. And that's globalization. Okay? When we think about the 30 years pre-COVID, it was the biggest boom in globalization in modern history. Right? The Soviet Union collapsed, half the world joined the Western markets basically overnight, right? We unite all of North America in the biggest free trade agreement in the world with NAFTA. And then 10 years after that, China joins the WTO and brings 1 billion people in their labor force with them, right? And so, like really simply put, we got access to a ton of cheap labor and materials in a really short period of time in the United States, right? And by the way, it happened to be like the internet and standardized container shipping. You can just arbitrage labor costs, right? And that's what a lot of businesses did. You move the factory from the United States to China, you cut your labor costs by 90%. That's great for your profits as a business, obviously, but hey, you can pass on those cost savings to the end consumer as well, right? And so I think this cheap labor, this boom in globalization, put a downward pressure on inflation in the United States for basically 30 years as globalization expanded. Long-term history of inflation in the U.S., 2% is normal today in everybody's heads. 100-year history is like 3 or 4% inflation is normal, right? So I think globalization is the reason why 2% just became normal in everybody's heads. Now, there's a downside to all of this, which is, things are cheap, right? Inflation's maybe a little bit lower, but your supply chains are going to get really long and complex. You're going to stop making a lot of things for yourself as a country, and supply chains might be efficient, right? But they're fragile. And so something like COVID comes along, and it basically, the entire supply chain falls apart for the United States in a very short period of time, right? We had the worst supply chain crisis, guys, since the OPEC oil embargo in the United States. I think that's the bottom line here. And so, in the aftermath of COVID, what you have seen in the United States is a massive bipartisan political effort to reshore certain elements of the supply chain back to the United States. Think like the national security adjacent industries, right? Semiconductors, green energy, pharmaceuticals, things of this nature, okay? And so, to show you what's been going on, and that it's not just all political rhetoric, okay, what I've done here on this chart is I just went on the US Census Bureau website, and I pulled data on manufacturing construction in the United States. So basically what this line shows is factory construction in the US over time, okay? And hey, from 1993, which is just as far back as the data goes, but think of that as like the beginning of this booming globalization I'm talking about, to basically 2020 when the pandemic starts, nothing really happens with factory construction. It trends up a little bit, but this is all nominal dollars, guys. It's pre-inflation. If I adjust this data for inflation, factory construction in the US was falling for 30 years. Right? Because we weren't building factories here, we're building them in other places. Well, then COVID hits. Doesn't matter who you voted for, all of a sudden you couldn't buy baby formula and toilet paper, right? And so it becomes very popular to say, hey, we want certain elements of supply chain back home. And so the CHIPS Act, the Inflation Reduction Act are passed. This is what we would call like industrial policy legislation on a bipartisan basis. Factory construction, guys, in the past 2.5 years in the United States has tripled, okay? It's pretty astounding. This is the biggest construction boom in the factory sector since probably World War II. We're building factories for the war effort. And so, it's gone more in 2.5 years than the past 30 years combined, right? And by the way, this chart does not include all the AI data centers and the warehouses and everything else. This is just like semiconductor fabs and pharmaceutical facilities and everything else. So, Guys, the good news is we're becoming more self-sufficient as a country, for sure. There's a lot of effort being made at doing that. That is not just like a political talking point. Okay, it's my belief, guys, like let's say China invades Taiwan in 2 or 3 years, it's just not going to matter that much anymore, right? We really are on the way to offsetting some of the worst of this stuff, right? Similar to like hydraulic fracturing in the United States, the biggest energy producer. We don't have to worry as much about what happens in the Middle East anymore. Okay, but there's a trade-off to all of this. If cheap labor and globalization kept inflation at 2% for 30 years, and we're not going to bring a bunch of business back to the United States, it's more expensive to pay Americans to do this stuff in the short term, right? And so it raises up that inflation rate, okay? And there's been a lot of debate about, hey, do tariffs cause inflation in the U.S., okay? And, my personal opinion, guys, I don't think tariffs by themselves can cause inflation, because the reality is a person has the same amount of money, and they decide to spend more money on the more expensive imports, because imports get more expensive with tariffs, there's no question about that, right? You just have to pull money from somewhere else in your budget. So the consumer price index is how we measure inflation in the United States. Like, keep in mind, there's tens of thousands of things in there, right? On net, the consumer price index doesn't change from tariffs. It goes up in some places and goes up less or falls in other places. On net, consumer prices don't really change from just tariffs themselves. I think it's reshoring, bringing all the business back to the United States that increases the inflation rate, because, hey, all of a sudden those consumers have more money to spend on stuff, right? You have to pay Americans to make all this stuff now. There's a higher labor negotiating power today domestically in the U.S. than there has been in kind of the past 30 years, because you don't have to compete with the rest of the world in the same way, right? You can go to management and ask for a bigger pay increase. I was looking at the data the other day, okay, top 10%, right? These are the people that we focused on a lot after 08-09, the financial crisis. Past year, the top 10% have seen wages go up about 2% year over year, okay? You look at the bottom 25%, so think about people like on hourly pay. Wages are up 6.5%. Okay, so you see like the bottom 25% outpace the top 10%. That's a total reversal of what we saw after 08-09 when all the pay gains were going, Wall Street or whatever else, right? So that's reshoring in action. And I think, guys, the reality is part of this is short term, okay? Part of this is a response to COVID, part of this is geopolitical in nature. I think reshoring is going to happen for the foreseeable future. Okay, I don't think this is a couple-year thing. I think we're going to see a lot of business continue to migrate back to the United States for a long time. And so, excuse me while I flip through all these slides, guys, but my biggest argument why reshoring is going to continue to come home really comes down to global demographics. Okay, globalization, these long, complex supply chains, they're really driven by one major thing, which is cheap labor. Okay? And the reality is all the cheap labor is going away. Populations are peaking all over the world. The supply of labor goes down, the price goes up, right? So what I did on this chart is I just pulled global demographic curves for the United States and all of our major competitors in the world, okay? And so, Europe, US, China, Japan, and India. And guys, everybody sort of knows about Japan's population rolled over in the 1990s. By the way, that's when their economy and their stock market sort of peaked, right? We were really worried about Japan back in the day taking over the world. It didn't happen, right? It's hard for your economy to keep growing if your population goes into decline. Similar thing happened with Europe in 2008. And like inside baseball, in the financial services industry, guys, like every year, there's this big argument of, hey, should we or shouldn't we buy a bunch of European stocks because they're undervalued versus the United States? And for 15 years or something, Europe's underperformed the United States consistently. I think that's one of the reasons why, right? The economy is just in decline in Europe because of demographics. China, though, is kind of the one I want to highlight here, because I think they're a poster child for, like, again, globalization and cheap manufacturing. China's population peaked in 2020. It's set to decline by 40% through the end of the century, okay? And these are numbers, by the way, that China gives to the UN. So I'm assuming it's probably worse than what they're just telling everybody, right? But big picture, like decline population of 40% is a huge problem for them, right? That's a lot less people, means labor costs go up. It's just less competitive to manufacture things there, right? Conversely, I'll kind of highlight the United States here because it plays in the point that I'm making. The U.S. population goes up through the end of the century. Okay, fertility rates are below replacement levels. Everybody knows that. They're higher than most of the rest of the world, by the way, but they are below 2.1 or whatever. What keeps that curve growing, guys, all I've included in there is legal immigration slots being filled. Okay, so I don't know what's going to happen with illegal immigration policy in 2070, right? I can't guess at that. So I'm just assuming all the legal slots get filled for the foreseeable future. That keeps the United States population growing consistently through the end of the century. China's population is in decline. Just on a comparative basis there, right? It's like, hey, manufacturing is going to make less and less sense to do in China and more sense to do in the United States. The same thing's happening, by the way, in Vietnam, in South Korea, in Eastern Europe, and a lot of places that we've done this in for the past 30 years. So, guys, I think reshoring is going to continue just because of global demographics. By the way, the next speaker is going to give you the whole argument for AI. He's going to go into a lot more detail than I can. But I'll just say, like, the stock market is basically at a record high today. The stock market believes in this AI theory, this thesis, this argument that's going to change the world, and I'm not here to dispute that. I'm here to say, if AI delivers on its promises, and it's developing a bunch of hyper-efficient, automated factories for us, what is the point of manufacturing things in countries with a bunch of cheap labor anyway? Why not just make it next to the consumers, right? So it's a combination of less labor supply globally and better technology, I think continues to bring manufacturing back to the United States for the foreseeable future, okay? Great for self-sufficiency, and maybe ultimately AI does totally eliminate the inflation side of this, but I think it also means probably baseline a little bit higher inflation. Maybe 3% is normal inflation instead of 2%. And by the way, if you look at the inflation reports today that come out, inflation today is higher than it was a year ago in the United States, right? It has not continued to trend down in the stable line. You strip out food and energy, which people always laugh about that, economists stripping out food and energy. The reason we do that, guys, is not because they're not important. It's just food prices go up, they come down. Like gas prices go up, they come down, right? Your commodity prices are sort of volatile. You strip out food and energy, what really drives inflation is wage growth, because I raise your pay, I can't really cut it again, right? And core inflation has been 3% in the United States for 2 years straight. We haven't really seen anything change. So I think 3% is maybe the new 2% in the United States because of this big reshoring trend that's happening, okay? I think that's one of the biggest changes that's happening there in the world. This globalization trend is reversing, really, guys, for the first time since the end of World War II, right? So big shifts are happening, and there's going to be some uncertainty that happens, right? But I think we're going to become more and more self-sufficient as a country, and that's the trade-off for a little bit higher inflation. So, all that said, let's talk a little bit about tariffs, okay? Because I mentioned this stuff's bipartisan, the reshoring aspect is bipartisan, right? Pretty much everybody kind of wants to reshore certain elements of the supply chain. The way the parties want to go about doing it is different, right? So Democrats sort of favor what we call industrial policy. That's the CHIPS Act and the Inflation Reduction Act. And I showed you guys the factory construction chart. I think that legislation did work in the United States, to be clear, okay? It's nice, it's like a scalpel. It's very targeted. You can pick industries, you can kind of target semiconductors specifically, right? With the CHIPS Act, that's what we did. The problem with industrial policy is it's really, really expensive. And we have a budget problem in the United States, right? More and more so recently after COVID. And so, CHIPS Act and Inflation Reduction Act, those are going to cost $3 trillion over 10 years, that legislation. Okay, and so that brings me to tariffs. Tariffs, I think, are becoming more and more commonplace and are going to be more and more sticky as a policy than people expect, simply for fiscal reality reasons. Okay, if we want to bring a bunch of production back home, industrial policy might be targeted, right? It might be a scalpel, but it costs a lot of money. Tariffs, on the other hand, are like a sledgehammer, but instead of spending $3 trillion to bring production back to the United States, the government collects $3 trillion instead. Okay? And so that's the chart I have on the screen here. I just pulled this data from the US Treasury Department. They call it customs and duties is how they categorize this, but essentially this is 95% money from tariffs. Okay, that's most of what this is. And you see how much it's gone up recently since April. Okay, it spiked significantly. And keep in mind, this is 12-month movie total, right? So I'm just including what's the past year, how much revenue we collected. So it includes essentially 6 months of last year before any tariffs were put in place, right? If I annualize tariffs from just like this year, we're talking about $300 to $400 billion in revenue for the United States annually at the moment, okay? Now, business comes back, right? We expect that to taper down over time. But, guys, that's the biggest tax increase since, I think, George H.W. Bush, right? That's a lot of revenue for the federal government. And so people are speculating right now what's going to happen after Donald Trump's out of there, right? All this stuff's kind of coming out of the executive branch. It's sort of chaotic. New president gets in there, obviously, he can do anything that he wants. Maybe they just repeal all these tariffs and we go back to the status quo. I'd say a lot of this stuff is sticky as a policy because of how much revenue it's bringing in. Okay, it's going to be hard to give up $300 to $400 billion a year. We also have these Supreme Court challenges happening around tariffs, right? And I am not a constitutional scholar, guys, so like, take what I say with a grain of salt. I'm just going to try and summarize some of this stuff, okay? Essentially, you have two different types of tariffs that are being implemented. You have national emergency tariffs, and you have national security tariffs, okay? The national security tariffs are like, hey, we're tariffing semiconductors, or we're tariffing pharmaceuticals, right? There's been a lot of that in the news the past couple of days. Critical industries that have a potential security impact on the United States. Those tariffs are not in question. They are not being challenged whatsoever, okay? I don't expect anything to happen with them. What's being challenged is the national emergency tariffs, okay? Universal 10% tariff. I don't like what Brazil is doing politically, so I'm going to give them a 50% tariff, right? Some of this stuff has gotten past its legal justification. I expect a lot of this to be knocked down in the Supreme Court, okay? And so I think we are going to see tariffs be removed or challenged significantly in a legal sense. A lot of them are probably going to have to get pulled, but maybe they just get reclassified as national security instead. I think it helps tamp down some of the chaotic nature of this stuff that just seems really ad hoc. I think there is going to be a challenge in the Supreme Court to a lot of this stuff, okay? But the national security type tariffs, I don't think they're going anywhere. So guys, I think a lot of this stuff's a lot stickier than people expect. Even if we have a Democratic president next, I think we're going to keep a lot of tariffs in place. That's exactly what we saw with the Joe Biden administration, by the way. He got in there, no tariffs were removed, right? I think we're going to see tariffs stick around for the foreseeable future because of the budget realities here. They just bring in a lot of money, okay? And the federal government would rather collect money than pay money to achieve this goal that they have. So let's talk about economic impact of tariffs, okay? Liberation Day happens, right? All these tariffs get announced on like April 2nd or 4th or something like that. The market very quickly goes into down to 20-something%, 23%. There's a lot of talk of a recession happening here. So there's a lot of concern around tariffs early on. And you've seen most of that reduce significantly, right? We're at a record high again. Most people aren't expecting really a recession in the United States, aside from these recent job market reports, which I'll address here in a second. And so I want to kind of give you guys like a mathematical, empirical perspective on like what can we actually expect from tariffs with like an economic impact, okay? And so I want to start with the job market reports that we've had recently. Okay, we had, I think it was like 66,000 jobs, which is much weaker than normal. And there's huge downward revisions to prior months that happened as well. Then the head of the BLS gets fired and replaced, right? And then ironically, we get another job market report that's even weaker, 22,000. We're set to get one on Friday, but it looks like the government's going to shut down, so that's probably going to get pushed down the can's going to get kicked. I don't know when we're actually going to get that job number. But, guys, a lot of speculation has been, hey, this is tariffs doing this, right? Tariffs are causing this huge decline in the labor market. So I want to address that kind of perspective here, and then I'll give you like the raw number on what I think tariffs can actually do to the U.S. economy. So what's going on with these jobs numbers? Why have we seen the job market slow down significantly? Okay, I think part of this has to do with COVID, right? We shut down the entire economy, economic activity collapses, right? We lose 23-something million jobs in 2 months. We flick the light switch back on, the economy booms, right? We're catching back up to where we would have been. So 2022 to 2024, let's say, I was basically calling that a reopening boom. GDP, job growth, everything, corporate profits, like everything was faster than baseline for 2 years because we're catching up to where we would have been without COVID, okay? I think part of what's happening here with the labor market is the reopening boom is finally coming to an end, okay? And if you just look at like the headline job numbers, right? It's, hey, we're kind of trending along. It's 120,000 jobs a month, and it's 66,000, then it's 22,000, right? It looks like it's dropped off rapidly, but that doesn't take into account all these downward revisions to prior months. Famously, like we just lost 1 million jobs, off the rolls. We overestimated by 1 million jobs, right? And those have disappeared. Well, now all of a sudden, instead of it going like this and falling off a cliff, it looks like it's a steady trend lower over time, right? So I think the reopening boom is just over. Like economic growth is slowing down sort of naturally, okay? The other thing that's going on here very clearly is the crackdown on illegal immigration in the United States is having a massive impact on these numbers. And that's because we've had about 3 million people coming into the country annually. Now that's basically zero. On top of that, you have like deportations, you have more enforcement at businesses, you have a whole host of other things happening, right? So you look at these labor market reports from the first 8 months of Donald Trump's presidency, because I think we have roughly 8 months of data. You can look at foreign-born and domestic-born employment in the United States. They have all this stuff in these surveys. Foreign-born employment is down by 1 million in the United States in 8 months, okay? Domestic employment is up 2.5 million. So that's 1 million jobs gone right there, right? That's a huge slowdown in labor market growth. You divide 1 million by 8, 8 months, that's like 166,000 jobs a month that aren't showing up, right? So I think it's the combination of these two things that's caused a pretty significant slowdown in the United States. But part of the reduction in the labor supply, there's less people coming into work, means that you need less job growth to happen to maintain like a low unemployment rate, right? So today, with all of the illegal immigration, we need about 40,000 jobs a month to break even on unemployment. So far in 2025, I think we're at roughly like 80,000 a month on average or something. I think it'll slow down towards like a baseline of like 40,000. I think unemployment is naturally decelerating, and then you have this huge reversal in immigration policy, the biggest since 1965, having an impact here as well. Okay, so I think it's really those two things that's having this big impact, not tariffs. And I'll tell you why. I'm going to walk you through the math and why I'm not that concerned about tariffs causing like a recession in the United States. Okay, I talked a little bit about self-sufficiency and supply chains, right? And I think that's a very key issue. But when we talk about the economic pie in the United States, GDP, we're actually one of the most self-sufficient countries in the planet, okay? And that's because most of the economic activity in the United States is what we call consumer spending. That's 70% of GDP, okay? We are not relying on exports for GDP like China or Germany are, right? Trade is just not a huge part of US GDP. So when you look at consumer spending, which again, vast majority of GDP is consumer spending, 70% of consumer spending is what we call services, okay? So what is a service? It's me getting up here and doing a presentation. It's the zoo hosting us tonight. It's going out to eat. It's getting on an airplane. It's getting a haircut, right? Services are the vast majority of what we spend money as Americans today. And you can see how it's grown over time. I think back to like the Oregon Trail game I used to play in like grade school. I wasn't buying a lot of services in Oregon Trail, right? I was buying bullets and like salt. And then I would crash into the river and die every time, right? People back then, maybe you get a haircut once a year, maybe you get a glass of whiskey like once a month at the speakeasy or something, right? There's not a lot of services happening. Okay, 70% of consumer spending services. The other 30% is goods. That's what would be, it's BMWs, it's TVs, right? It's things that could get tariffed at the border. Only a third of those goods are imported goods in the United States. Okay, so when you really look at the math, 10% of consumer spending in the United States is imports and subject to tariffs of any kind, right? So $9 and $10 are not subject to tariffs. It also really matters where the imports are coming from, guys. I've got our biggest trading partners up here. Okay, so this just shows the share of imports from China and the share of imports from Canada and Mexico. Canada and Mexico are about 30% of US trade, or a third of overall stuff that we buy, right? We've all seen 25% tariff on Canada and Mexico. And there's individual tariffs on things like auto parts, or like copper, or steel, and aluminum, and things like that. But the vast majority of trade, guys, between the US, Canada, and Mexico is duty-free. The tariff rate is 0%. Okay, about 85% of trade is 0% tariff. That's because of the USMCA agreement. There's North American-made input requirements. And so if I go to Whole Foods and I buy an avocado from Mexico, that's grown in North America. It's tariff-free, right? Where you get into tariffs is, say, like, China imports a bunch of synthetic fabric to Mexico, Mexico turns it into blinds for your house, that might get hit with a 25% tariff, right? Because it's not made in North America. But you can see how a big chunk of trade is essentially duty-free. It's not at that 25% rate. Okay? The big concern here is China, obviously. They're like the 800-pound gorilla in the room. They're the ones we're all the most concerned with, right? They have control over key bottlenecks and supply chains. But as a share of overall US imports, China's been falling pretty rapidly since 2018 when the first trade war started. Back then they were 20% of trade. Today they're about 13% of trade and falling, rapidly. If you just look at, again, the math here, okay, 10% of consumer spending is imports of any kind. China is 13% of US imports. That means China is 1.3% of US consumer spending. Okay, so I'm not here to tell you guys that tariffs don't matter. I'm not here to tell you that this is 5D chess. There's plenty of critiques I have, right? I think this has been generally very chaotic and like weirdly managed. But at the same time, it's pretty limited impact on the overall US economy, right? Trade is just not a major portion of GDP. So what is an actual estimate? I'll give you guys some round numbers, okay? For anybody that's like really interested in this stuff, if you want a resource, I really suggest the Tax Foundation. The Tax Foundation does analysis of all tax policy and economic impact. So tariffs are taxes, right? They do an analysis of tariffs. They've been doing this analysis since 2018 when the first trade war started with China. So I think Tax Foundation does by far the best analysis on this. Okay, they look at the same data that I'm looking at, and they say we don't like tariffs, but hey, the reality is, most of U.S. economic activity is domestic. The biggest tariffs are on countries that are a minority of U.S. trade anyway. They come to the conclusion that ultimately all these tariffs go into place and stay in place, because how do you model like a trade deal? Right? You can't put that in an Excel spreadsheet. And they come to the conclusion that ultimately, because of tariffs, long-term GDP is lower by 0.9%. Okay? And that's not like quarter-over-quarter GDP falls by 0.9%. It's like 10 years from now, GDP is lower by 0.9% than it would have been if like tariffs had never been put in place, right? So they're accepting that GDP will grow. It's just going to grow less than it would have without this stuff, right? Over 10 years, guys, like 0.9% is, it doesn't even show up statistically in like a quarterly number, right? It's very small. And so maybe a good comparison point to give you too is we just saw this big like tax legislation get passed as well. The BBB, the Big Beautiful Bill. The Tax Foundation does analysis on that too, right? It's tax legislation. They come to the conclusion, hey, Big Beautiful Bill increases long-term GDP by 1.2%. So I basically tell you guys it's like a wash between these two things. A little bit of positive, a little bit of negative. Maybe a little bit more positive than negative. And really, like, I don't know about you guys, like the biggest takeaway I get from that is how small the numbers are, okay? Government policy, it takes up most of the oxygen, right? Everybody's talking about the government shutdown now, we're talking about Fed policy, we're talking about tariffs. The reality is government policy, like, it can tinker around the edges, it can have effects on the margin, but this stuff is not what drives the economy long term, right? That's population growth, that's innovation, that's a whole host of other things that the government can kind of incentivize a little bit, but they are not the be-all and all what happens in the United States. I think we have a lot of natural advantages over here. I think we're going through sort of a chaotic period with supply chains reversing and globalization changing for the first time in like 80 years. But big picture, I'm like optimistic about the United States economy. I think we'll come through this probably stronger at the end of the day, even though there's a lot of bumps in the road that we're going to have to go through as So I think that's probably a pretty good place to end and do some Q&A. I really appreciate you guys all coming out. Sorry for all these extra slides too. I'll put this up here before we do questions if anybody has some. This is just a couple examples of pieces we put out at First Trust. Everything's one page or less, easy to read, easy to share, it's all free. If you guys like this stuff, I think it's worth signing up for. You can also follow me on LinkedIn if you don't want it in your inbox, right? We'd be happy to have you as readers. So thank you all so much, and I'll wrap it up there.
Does anybody have any questions? I can walk around your table if you have any questions for Bryce. No questions. You did a great job.
Oh, thank you so much.